What's up, everybody? Steve here. Thank you so much for your time, for taking a look at this video. I think it's very important. I will link this article down below for you guys in the description, but it talks about the headwinds confronting the mortgage industry in 2022. Now, this article is pertaining to just giving an insight or maybe even tips for mortgage related companies, any kind of lenders, direct lenders, mortgage companies, loan originators, mortgage brokers. And basically it's giving them an insight into what is ahead for potentially their businesses or their careers. Now, this is good, even if you're not in that business, this is good to understand as well, because a lot of these companies we're probably going to see go out of business, or they're going to be severely downsized. And I did another video on Better.com, which is an online mortgage company who did mass layoffs. And I think that that's just the start of it, because you got to understand, in the last 2 years, we've had I think it was like 73% of all loans originated were in the last 2 years. And that is significant. And that takes in consideration refinances, but new purchases as well. So there was a lot of loan origination. So a lot of people needed to be employed to service the amount of people that were coming into the market to purchase or to refinance, because ultimately we had a artificially low Fed rate as well as artificially low mortgage rates that caused this. And I think, in my true heart, I believe it's causing a mess, and we're going to deal with it. But I'm going to talk about this article, and then toward the end, I'm also going to talk about what you guys can do to prepare for credit tightening. Credit is going to tighten. Lending is going to tighten. So there's certain steps that you guys can take, because I think there's going to be mass opportunity for people buying real estate when property values do go down. I anticipate that they are going to go down, and it'll be important to have the ability to access credit, to access financing for when these properties do go on a decline. So I think right now is imperative to do certain things to ensure that you guys have the ability to get financing when this does happen, because you guys will be able to buy more assets at that time. But let's jump into this article. It goes on to say, as we approach 2022, some concerning headwinds confront the mortgage origination industry. For companies to survive and thrive, mortgage executives must focus on 3 primary factors: risk, strategy, and efficiency. In terms of managing financial risk, considerations include interest rates, markets, and reputation. Risk is becoming more pronounced as the Federal Reserve announced its plan to start tapering mortgage-backed security purchases by $5 billion, which is not a lot considering on how many billions they've been buying every month, which will inevitably cause the market volatility. In addition, the Mortgage Bankers Association forecasted that refinancing volume will decrease by nearly $1 trillion in 2022. Let me repeat that. Refinancing volume will decrease by nearly $1 trillion in 2022. That's massive. Such a massive drop would create high-level risk for financials of many originators. Now, managing balance sheet risk. To effectively confront these challenges, managing balance sheet risk will be the key. This includes focusing on capital equity to ensure the foundation is strong, covenants are met, and operational flexibility is maintained. I put a little note here. Ultimately, what I'm reading is they're ensuring solvency and essentially not preventing themselves from not going out of business. So they want to ensure that they are solvent, they're making money, and in that, they're going to have to make some drastic moves. And the first thing is probably cutting a lot of jobs, which is going to have a detrimental effect. So if you guys are in the mortgage industry, you guys need to be prepared for something like this. If that is your career, that is your job. Originators will need to run their businesses more efficiently to protect balance sheets and avoid capital erosion. Companies with broader product offerings, such as non-qualified mortgage, which are QMs, loans, are better positioned to handle this adverse environment. And non-QM, these are basically loans that will be able to finance people in unlike the W-2 employee, these are people that are self-employed. They have unique tax returns. So basically it's saying if direct lenders are able to provide these types of products, they're going to be in better shape than companies that just will not offer this type of product. The heightened volatility and volume decline we can expect in 2022 are likely to present opportunities for consolidation, as many originators face significant operational difficulties. They may become more open to being acquired. And I got a note here: gold rush in origination loans, refis, but as soon as it slows, income's going to be reduced. So essentially what they're saying is a lot of companies probably have overextended themselves because they needed employees. Some companies probably didn't even see the writing on the wall, and they invested into maybe huge leases, long-term leases for, expansion, bigger buildings, nicer buildings. Even the rich people are not financially astute, and the rich people, they don't have necessarily the best financial intelligence, and a lot of rich people are controlling a lot of these companies. So I bet you there was a lot of frivolous spending and just buying yachts and stupid shit. So basically this is saying that companies are going to be distressed, which is going to create opportunity for other financially astute companies to basically buy these companies out when it happens. Okay, so now what can you do to ensure that you guys are prepared for maybe a market crash? You guys want to prepare that you guys have financing lined up when you guys need it to buy into some distressed assets. Now, again, if you guys are in the mortgage industry, based on that article, take a look at it. It's kind of scary stuff, but basically, you just want to be prepared if, you want to be prepared for layoffs, bottom line. Now, again, if you are planning on buying distressed assets when they do hit, also, what we're going to do is when this does happen and we're going to see more distressed assets come to market like foreclosures, I'm going to be personally buying some, and I'm going to show you guys how I'm buying them and bring you through that whole process too. So if you want to see that, be sure you subscribe. So what can we do? Preparing for your lending needs. For one thing, higher credit scores are probably going to be required. So if you guys are bordering, you're in the 6s or whatever the case is, be sure you do whatever you can to bring up that credit score. So there's tons of information out there on YouTube and everything else. Just start doing your research. Maybe I'll do another video too on how to better your credit score. But take the time, spend the time, even if it's, a half hour, a couple times a week, to start working on bettering your credit, because twofold: the better credit you have, the better interest rate you get, and also the better credit you have, the better chances you have for getting the loan. And also, sometimes they're going to even require a higher down payment if your credit is bad. The next thing is DTI, which is debt to income. They might need a higher income. So if you guys do need to make more money right now, you might have to think about changing jobs. You might have to pick up a side hustle of some sort. But anything you can do to show more income right now is going to benefit you for your previous tax return. So let's say 2023, 2024, we're starting to invest in distressed assets. The tax returns from 2022, 2021 is what we want to beef up. We want to show as high income as possible. Now, also, the formula for the debt to income is also less debt. So the less personal debt, personal liabilities that you guys have, the better. Now, this doesn't necessarily consider debt that's associated with an income producing property or income producing any kind of asset, but it's any kind of debt that is associated with your personal finances. So any kind of credit card debt, car debt, maybe the debt for your personal mortgage, any kind of debt associated with that's taking money out of your pocket every day is going to work against you. So be sure that you guys figure out how to get out of personal debt. The next thing is higher reserves. So I talked about this in another video that I did in terms of should you buy now or should you wait? And I talked about people that I've seen over the last several years. They're buying real estate and they have basically no reserves. You know, they might be required to have 2 months worth of reserves, which is insane. People are taking out $400,000 loans on houses, and they have 2 months of set reserves. I mean, you're talking one bad day away from basically defaulting on your mortgage. So get higher reserves in. If you guys can, I highly recommend having 6 to 12 months of reserves in place for a bad rainy day, especially if something happens in your job or whatever the case is. And banks are going to start requiring higher reserves, in my opinion. They want to mitigate their risks, and this is the whole point of doing this. So they want to see that if this person does default, they have 30 grand in another bank account that will help to pay their mortgage until they can get back up on their feet. The next thing is higher down payment. This goes along the lines of also, creating a side hustle or making more income, or even bringing down your personal overhead. The less money you're spending on your personal overhead, the more money you can set aside for a down payment. So I'd suggest having at least 25% down for some of these distressed assets. I'm a big proponent of not over leveraging, even if the real estate market takes a dump and we're getting prices very, very low on real estate. I still want to have a good chunk down on these properties. But the good thing too is, let's say a property is 300 grand and, it goes down to 200 grand, 20% or 25% of 200 is much different than 300. So it's relative based on the decrease in valuation. And lastly, job stability. A lot of people, there's a mass migration of people moving out of certain jobs, and I'm all about it. Like, if right now is the time, because there's a lot of employers that need people, and if there's any point in time to change careers, it probably would be now. And anyway, point I'm making here is a lot of lenders, they're going to want to see job stability. So if you guys are changing jobs and you're in a new job every other month, it's just going to look bad for you. So I highly recommend getting into something where you guys can be there for a good duration of time, so it just looks better for your income analysis when an underwriter is going through all this information to get you guys your financing. Anyway, guys, I appreciate your time for being here. I really do. It means a lot to me, and I'm hopeful that this is helping you guys out. And if it is, and you want to share this video, I appreciate it. And there's other videos coming on the housing market and investing and everything else. So if you're not a subscriber, consider doing it. And I appreciate your time today. Thanks for being here.